today, what we're going to do is we're going to go even one level more of sophistication. Now, whether or not you have a philanthropic bone in your body, you're going to enjoy the talk today, because what we're going to be talking about is gifts that provide income. And so, Jim, talk about a little bit about what you do, and it's all yours.
Well, thank you. And first of all, thank you for what you do here, Peter, with these seminars, these presentations. I've known Peter for many, many years, and I just think this is one of the nicest things that is offered for people, that they can come, no axe to grind, you just get solid, straight information. And I applaud you for investing the time to just learn. So it's an opportunity and a privilege for me to be here today to talk about another company.
People have nothing else to do.
Okay, yeah. Then if you don't have anything to do, please be a volunteer at Mission Hospital. I'm just glad I'm not over in that class. That looks a little bit dicey over there. They're swinging swords. This is going to be very deep. Peter said a higher level in terms of sophistication. I always use terms as far as the level of water. When I was a kid, I took swimming lessons at the YMCA, and I didn't have everything down pat, mainly the breathing. Okay, so at the end of the thing, they drop you in the deep end, and you have to swim. Well, I just paddled and I just prayed that I was able to get to a level that was a little bit not as deep as where I was in, and I was able to get there. So it's a deep water. We're going to go into a lot of deep water now, and any one of these could take 2 hours to go into detail. Please feel free to ask questions. I'll either do one of two things. I'll either answer it right away, or I'll say, I'll be getting to that in just a moment. Now, if you notice that after a few moments, I haven't gotten to it, please do not ask again. That's just my polite way of saying I don't have the answer. Okay? I'm human. But I know with this gentleman here that if there's something that I do not know, he knows it. So we're pretty well covered here. Also, another interesting thing, I'm originally from Philadelphia, which accounts for the accent, and I came to Orange County 25 years ago, and I was amazed. I did some studying and checking out with statistics and things like that, and I learned by my surprise that mortality rate in Orange County is 100%. So it's a good thing that you're going to this, all right? All right, so everything we're going to be talking about today has a charitable aura to it, to one degree or another. Now, Peter hit the nail right on the head. Some people are not charitably motivated, and that's fine. Some people are charitably motivated for their university or their favorite mission organization or their church. It doesn't matter. I'm a person who believes in philanthropy because I know it works, and I believe that things that done on the private sector in that arena do much better. They're more efficient by and large. So everything we're going to. What do you think? What is the number one charitable group in the United States? Where people give the most money to?
The Red Cross?
No.
No.
Community chest?
No.
Church.
Church, yeah, church. Church giving is up there, and
2 minutes before you die.
But what I'm going to be going through here very rapidly, and then Peter and I have not done this. This is going to be a dog and pony show, so I don't know how much of the dog or how much of the pony you're going to get, because see, like he likes to take center stage, so do I. So we might be duking it out here. Very quickly, you're going to go into something next week about IRAs. Just for your information, if you are considering some type of a charitable bequest, and I don't blame Mr. What's his name? Mormon. What's his name? Buffett. I'm only kidding. A lot of people say, you know what? I'm well heeled, but I do not want to. I don't know what's going to happen. It's uncertain. So therefore, I'm going to do my charitable giving at my death, and that's perfectly okay.
How do they know when is the death?
Excuse me?
How do we know when death is coming?
As I say, all I know is it's 100%. I don't know the timing. I just know it's 100%. But when you're considering, the disposition of an IRA, you may want to look at that as the component in which you carry out your charitable giving at death. Why? Well, because IRA assets are subject to, there's a whole lot of, we got the IRS, we got the IRA, we got income in respect of IRD, income in respect of a decedent. It's just, and I'm not going to go into detail, just by the nature of that asset, it is subject to potential double taxation to the heirs. I don't want to have to go into details, but you can escape that if you have that going to charity. So let's say, for the sake of argument, part of your estate is $100,000 of XYZ stock and $100,000 in your IRA, okay? And right now you have, because you've been told it's always better to donate stock because you avoid the capital gains tax, and it's true during lifetime. But in your mind, you say, I'll give the stock to the charity and I'll give the IRA to my children. You probably would be better off doing it the other way around, okay? Just like I said, conceptually, all right, does this work every time? Is this all the time, works all the time that way? No, every situation is different. You're all like snowflakes. You have different situations.
You're going to give the reason?
No, because we don't have enough time. I mean, like I said, there's so much that I just want to give ideas here, little stars. If something should ignite there, you could talk to Peter. I will give you right now on the front. You can write this. You have my cell phone number. Very few people have that, and if you call me after 10 o'clock at night, I'm not going to be a happy camper. But let me give you my email address. It's jim.f as in Frank, R-E-Y at stjoe.org.
Can you repeat that, please?
Peter's written it down. Oh, you didn't write it down. What are you doing here? Okay. I thought you were writing. It's Jim dot
J-I-N.
M. That's my name. Jim. It's not Jin. All right. Jim.Frey. This is going to be a long session. Dot. Yes. Frey. R-E-Y. At. S-T as in Saint.
A-S-T as in Saint.
J-O-E.
J-O-E.
.org.
.org.
Yeah. If you have any questions at any time, please feel free to email me, call me, or whatever the case may be. And also on the very bottom of here, I gave you a direct link to our website, which is our gifted estate planning website. It's just tons and tons of information that you can sit down, read, and ask and whatnot. So let's continue on. And that's why I don't want, there's going to be a lot of stuff here. And like I said, the water gets very deep here. All right, first, and what Peter said earlier is that these types of gifts, with the exception of what we just talked about, everything we're going to be talking about provides a now benefit either to you or to your estate. One of the most simplest in terms of in the whole arena of life income gifts, which is a very complex arena, one of the simplest ones in that whole ball field is a gift annuity, charitable gift annuity. Now you're going to notice something very consistent with all of these things that you're going to see here. You're going to see 3 boxes. And it's a very nice way of kind of just tracking what happens to the asset. Now, with a gift annuity, charitable gift annuity, a person makes a donation to the organization. Organization takes that money and puts it in a special reserve account and then pays the donor or donors, if it's a single person, husband and wife, life income for the rest of their life, guaranteed. Now, how does this all happen? Is it some kind of magic? No. It's done with actuarial calculations, present values, and all of that stuff, and reserve accounts. In the state of California, and it's very important for you to know this, in the state of California, any organization that issues or claims to be issuing this must be certified, must be licensed by the state of California. And if, let's say, you like this idea, it's kind of strikes a chord with you, and you have like the Deformed Puppies Association, and you want to, and they have a gift annuity program, make sure you say, are you licensed? Have you been approved by the California Department of Insurance? And if they give you a blank stare, they don't have it. So can they issue a gift annuity? I guess they could, but it's illegal in the state of California. Why? Because the state of California Department of Insurance is looking after you. Because what happens is that they make the charity set up certain reserve requirements so that that annuity is going to be paid. Now, in this particular case, John, I got to print these things larger. This is too small for even me.
I can't even read it.
Yeah, okay, I apologize. Next time I'll do it 2 per page, okay? I was just trying to save trees, okay? I'm a greenie, what can I say? But here we got John, and he gives $10,000. He receives income at 6.5% for the rest of his life. A good portion of it is tax-free. So you can see there, he gets $650 and $473 is tax-free. So his effective rate, all right, follow me on this because it's a matter of just playing with the numbers. The rate that he gets is 6.58%. But because a part of it is tax-free, at the end of the day, what I always say is, how much do I have to buy beer and pretzels? Because beer and pretzels is the only thing worth living for, right? And dark chocolate. So how much is left at the end of the day? And I do this thing where it's a chart where when I'm talking to an individual where they have, say, a CD or something like that, I say, what are you getting with the CD right now? I was getting 3%, now they're going to give me 2%. I say, okay, let's look at it. We go down here. All right, if you get 2%, how much you get? One of $10,200. What is your tax bracket? So we do the calculation. Say, okay, after taxes, the net spendable is X. But when you have something that's paying 6.5% and about 60, 70, or 80% of it is tax-free, that has a very powerful impact on how much you actually walk away with. Another important thing to remember is this tax-free element. It goes for a certain period of time. And that's basically your actuarial life expectancy. Because we do have calculations to say, if you are 65 today, based upon actuarial assumptions for all people age 65, your life expectancy is 18.6 years, all right? Does that mean that at 18.6 years from now I die? No, only if God says it. But the actuarial tables just take a look at all numbers. So you get partially tax-free income. It's guaranteed, depending upon a person's age at the time they go into it, and you get an income tax deduction because you are making a gift. Because with this $10,000, if a person was charitably motivated, they could say, you know what, I'm just going to give it to the church. $10,000. How much of an income tax deduction does that person get for having made a $10,000 contribution? Anyone? All right, we got a good group here. With that same scenario, if there's a string attached, I'm getting something back. Well, you're not going to get the $10,000 because the IRS, they're not as stupid as they appear. They're going to say, well, wait a second, you haven't really given $10,000 outright. You retained a lifetime income, so therefore your deduction is going to be limited. And so in this particular case, his deduction is $4,418. Now, I think I guessed at this, or I used for this calculation, his tax bracket. Because your tax bracket is very, very important as to the value of an income tax deduction. So if you're in a 15% tax bracket, it doesn't have as much meaning as if you're in a 30% tax bracket. And I'm talking about combined, state and federal. That's the gift annuity. The next one, we're going to go real quickly because this is a husband and wife. Can we do that? Yes. And the numbers look the same, except that it's a little bit lower. Why? Because we are guaranteeing income for 2 people. So we have John in the first one there, 6.5. John and Mary, 76 and 76, 5.8. And then if you go to the next page, we've got John a few years later at age 84. And lo and behold, it's 7.9. That's not too shabby. So when I'm talking to people who are in their late 70s, mid 80s, and they've got CDs, and they're just, I don't know what I can do, this kind of registers, okay? So here it's 7.9%. Now, if it's John and Mary, it's 6.9%. So these things are pretty well self-explanatory in terms of all 4 of those all 4 of these illustrations, okay? The concept is the same. Separate, they make the gift, income, ultimately gift goes to the charity.